Have notes become the new alternative? Stay tuned. Hey guys, welcome to this week's edition of Note School TV. Well, and this is our monthly update, our most anticipated show of the month. And guys, we've got some data for you today. So guys, on how to work inside this crazy market that we're going through. So number one, make sure and like today's episode. Make sure and comment on today's episode, and please make sure and share it with your friends. Yes, you have our permission to share this with everybody that you know, because, well, the more you know, the better you are, the better the investor you are. So make sure and like, make sure and subscribe if you have not already done so. And number three, make sure and hit that bell notification. Yes, hit that bell notification right now to make sure that you're notified every week when we are about to go live. When? At 11:05 Central Time every Wednesday. And again, if you'd like to know more about what we do at Note School or to attend one of our master classes, simply go to noteschool.com/TV. Again, noteschool.com/TV. We have a lot to do today, so let's bring on my friend, Note School's Chief Visionary Officer, Mr. Eddie Speed.
Good morning.
Good morning. Good morning. Good morning. Good morning. A lot going on, sir.
You know, Joe and I, we started on this literally. We all throughout the month we're gathering stuff, and I mean, we've discussed this before in different changes and stuff. But we started out with such a news topic. There was too much to discuss, and we've been cutting and compiling. And so, Joe, we'll share my slides here, and I just want to kind of start out today and really talk about sort of in summary where I think what the news summary today is going to be about. So we'll do it a little differently. So we can show that. And, you know, Joe, I'm just going to kind of highlight as we go here.
Yep.
One of the things that we're going to say today is housing is softening. And so we're not, it's not a boom anymore. And you're going to see the data as to why that's true. We're not in for a complete crash. Joe, we're buying non-performing notes now at a rate we haven't been buying them in the past.
That's right.
Right. So we're in a good market to buy delinquent notes, but our collateral is not dropping like a knife like it did in 2008.
That's right.
We're going to talk a lot about commercial real estate today. If you see that symbol right there in any kind of news feed, you know that is how they're referring to it. We're going to say, as they said in the TREP report, Joe, substantial headwinds.
Yes.
Right.
Yes,
and we'll talk about that. Banks are really struggling. And we're not like sitting in the stands. Yahoo! Banks are dying. But I will tell you this. The one common thread, Joe, since 1980, when I entered this business, is when banks are struggling, it always makes the note business good.
It makes it huge. That's right.
It's happened every time. As the banks are struggling right now. If the note business was a 2 last year, and as far as buying notes, it wasn't as far as creating seller financing and creative financing.
Right.
But as far as finding notes to buy last year, we were not. The industry was struggling. You know, timing's everything, Joe.
It is.
Right.
It is.
And last year we were struggling with this, and we were saying that because that's why we were switching over and talking a lot about creative financing. Well, this year it's a 7.
Yeah.
So understand that this is what we're saying. When the banks are in distress, basically the note opportunities are when banks are in distress. It's causing discounted notes to be sold. It's either their clients selling notes, or it is the banks themselves selling notes. And that is exactly what we're seeing right now. So I would comfortably say to you, Joe, that last year, 2022, that 22 versus 2023, I would say comfortably, you know, if I really gave a report card on last year, I'm going to say we were at a 2. And I say by this summer now, we're at a 7 this year.
Absolutely.
And one thing that's really happened is good multifamily deals, good deals, real deals
Right.
are
sure.
very, very scarce, very scarce. And
a lot of unknowns in the business for sure.
Yeah. And so here's what I think is a result of that, Joe. What is a result of that is when notes are scarce, when good alternatives are scarce, then notes have become the new alternative investments. The traditional alternative investment, alts, they call them.
Mm-hmm.
The traditional alternative investment has been multifamily.
Yes.
Well, if multifamily isn't the pony to ride, what is?
Yeah.
And by the way, we're training people in the multifamily business now because their asset class is struggling, but they're still good at raising money. Just stay with the jockey, just switch the horse.
Right.
Right.
Yep.
We'll talk more about
Good
that.
analogy. Yep.
We have a lot of stuff to cover today, Joe. We're going to try to be fast. We're going to start out with housing. And Joe, let's rip it. Let's go.
Well, this is just, again, new listing of homes down 23%. Inventory is still a struggle. And, Black Knight, who we get a lot of data from, it continues to say that. The inventory is still there is not there. Demand is still there, but the inventory just isn't there. 23% is a huge number, Eddie.
Yeah, I agree with that. And right here is where we are. And of course, this is, you see this overlay of 2022, right? Mm-hmm. And 2021. But this is the one that we're tracking right here. This is for this year.
Yep.
And so we are struggling in inventory for certain. And
this was from Clever Investments, and I picked this up, and it was and it's just a report card between 22, 23. How many Americans experience buyer's remorse? Well, home buyers, nearly 93% have regrets in their home buying experience, up from 72%. That's about everybody, Eddie.
Not much to say about that.
It just is what it is. And a lot of things going on when you're buying, especially with regular bank lending, right? And that's the biggest reason.
Joe, I have this conversation daily with seasoned people, daily, that sometimes when you got a little gray hair and you got decades in a business, you can't just follow everybody else.
Mm-hmm.
And and when we saw this FOMO, and you go back and look at Note School TV episodes, Joe and I were sort of laughing about it. Like people have kind of lost their minds.
Yeah.
And well, sure enough, kind of figured out that's right. Lots to go on in banking and lending, Joe. Lots to say about this.
Yes.
Right.
Boy, the mortgage credit availability just continues to drop. Look at the difference between those two red lines there, Eddie.
Yeah, this is basically right in here is when the virus started. Right. And you saw when the virus started, we saw this gigantic drop in we discuss this every month.
We do.
But Joe, look at the trend. Okay. So we've been trending down for a good while. So people, like mortgage lenders weren't looking at real estate quite like other people. And Joe, we're back to where we were in 2012.
And that's when we were trying to come out of the Great Recession.
The same standards that it takes to qualify for a loan are back where we were 11 years ago.
That's right.
Okay. And we got different charts on the rates. I like this chart, Joe, because it reminds us. You remember this literally in January 22.
God, that was a long time ago.
It seems like 18 months ago. And look at y'all remember these days, these runs and stuff. And of course, rates here's 7. Now, by the way, these are the interest rates on the notes, guys. This is not the effective rate you pay when you get a loan.
It's not the APR. That's right.
Yeah. So that's the top yellow line is 7. APR is going to be about 1 to 1.5% higher than that.
That's right.
Right. And so this is the average rates. Remember, once again, this is from National Mortgage News. Same thing. If you look here, Joe, here's 8% here.
That's right.
and here's 6% here, and you kind of see the waiver lines. But remember, this isn't the APR. This isn't the annual percentage rate. This is the interest rate on the note itself.
That's right.
Okay. So this just shows you a little shorter time frame. This is 1 year.
Mm-hmm.
And Joe, this is the APR.
Yeah, that slide is the APR versus the rate we just showed you.
And that's 8% line right there.
Yep.
And this is the 7% line right here. Okay. So understand, now it's easier to see, gosh, rates on FHA loans keep kissing the heck out of 8%.
And you know what, Eddie? That's with 20% down with a 770 credit score.
Yeah. So, so then, so this is where the hockey puck has been.
Mm-hmm.
And we thought it would be kind of fun to say, where's the hockey puck going through the end of the year?
Yeah.
Okay. So, Joe, if we look at September and August, we can see kind of a surge in rates. And if and they don't go down much. And then if we look at December, we're seeing, so now all of a sudden you start understanding why these forecasts say what they're saying. Right.
And why you have those wiggly lines, Eddie.
You know, Joe, you sit around the barbershop and you hear a lot of hot sports opinions or some of these social media platforms and stuff. We just try to source what the experts are telling us, and that's just what we're trying to. Like, we're not trying to make it worse than it is or better than it is. We're just trying. We're making decisions.
Yeah.
Right. Now, Joe, this once again, this is home buyers, the effectiveness of the rates and what their payment is.
Yeah.
Right. And by the way, we have an analogy that we've done on Note School TV. We're going to talk about that really quickly. John Burns, who is a very renowned real estate forecaster and information data gatherer, very respected guy. And we did this last week, but he talked about the cost of owning versus the cost of renting.
Mm-hmm.
And basically, this is the rent line, Joe. So this line right here, everything below that is rent.
Mm-hmm.
And everything above that is a mortgage payment above rent.
Right.
So we drew a little analysis here. We did this last week. I'm just do this super quick. That's rent, and just say that's $2,000. And he said this is on a starter home, by the way.
Right. Yeah. Yeah.
And then this could be a seller finance note. Now, Joe, that's assuming you seller financed at mortgage rates and didn't get any interest rate above mortgage rates.
Right. Exactly.
And most of the time, people seller financing would get a little higher rate than this.
Right.
And this is $1,000 more income that you could get from seller financing than just renting. Oh, and by the way, some of these numbers in here are expenses.
Absolutely. And that $1,000 more is bank income. It's net income, not gross, but net.
Yeah. So if this were $3,000, who wouldn't do that? So we talked about that last week. I just want to remind you, I had a lengthy conversation with a super seasoned real estate investor literally yesterday, Joe.
Mm-hmm.
And we had a long conversation about this exact thing. And every house that he's coming up vacant right now, he's seller financing. And I'm telling you, a year and a half ago, that was not what he was doing.
Wouldn't even listen a year and a half ago.
Well, I mean, we're old industry buddies.
Right.
He's our friend Tim, by the way.
Right. Yeah. Mm-hmm.
And he's in the lending business. But he just says it just makes more sense for me to do it. And I said, heck yeah, it does. So, Joe, let's talk about this for a second.
Yeah, this is some really great information from Black Knight, and this fella is a representative of Black Knight, and and I like what he said. He said new construction is coming up on the horizon, and it is trending up. So, but demand is still down 35%, right? Yeah. And prices, he says, will trend up over the next few months. But for sale inventory, Eddie, is down 51% pre-pandemic. And then I like what he said. He said, with the Fed, the same lever that is squashing demand is also squashing supply. And, he basically says that supply won't come back as soon as demand will.
Yeah. So basically he's saying that we're trending down and we're seeing a dip in the market. Very different in new home sales versus existing home sales.
Right.
So yeah, really, really a big factor there. So I would say in summary, I think what we tried to say was correct. We're seeing a softening in real estate. Most markets, not every market, most markets are looking at a decline at the moment. And
West is getting hit hard.
And likely a decline in values through the end of the year, right? Now, there's micro markets that's not true in, so that may not be exactly true in your neighborhood, but we're saying from looking at national data, that is sort of what the information is leading to. But, Joe, remember, we're buying a lot of residential defaulted loans. And the good news is we're not looking at a falling knife market in residential real estate.
Right. No, we're not.
All right. A lot to say about commercial. And it's funny, Joe, like commercial wasn't a big topic a year and a half ago.
No.
We try to bring the topic to the market when it matters, right? So Charlie Munger, everybody know who he is? He's basically Warren Buffett's right-hand man, right, Joe?
Yes, he is. Sharp, sharp man.
And basically what he said was commercial real estate market is in trouble.
That's it.
There's no nice way to say that, is there, Joe?
No, there's not. It's the market is what the market is, and the investors, well, the money's getting more expensive, Eddie. When the money gets more expensive, the numbers don't work as well.
We were trying to find the best picture of old Charlie, to be honest with you, but the old fellow's 99 years old. I'm not making this up. We were late for trying to get on and get ready with our producer to do the show today.
And he said, "I thought you were going to find a better picture.
I thought you found a better picture of Charlie Munger." So let me tell you something. I will sign a contract today if I have his mind and his health, and I'm 99. Okay,
absolutely.
Let me tell you something. That old gray hair means something right now.
Yeah. It does. And Eddie, just as an aside, I was back years ago, 40 years ago. One of Warren Buffett's neighbors invested $60,000 with them in Berkshire Hathaway. It's worth $400 million today.
Yeah.
He and Charlie. Yep.
So anyway, a lot of people don't know this, but Charlie's prior background is he was a multifamily guy in California.
He was.
That was his day job.
Yeah.
And so he understands this space pretty well. And overall, he's not saying we have a 2008. We're going to have some things that are really, really tough in the market. So this is my friend, Joe, Mr. Paul Moore. Yeah. Good fella from Virginia. He's my buddy. In fact, we've done deals, worked on deals with him, actually worked on deals with he and his son. Mm-hmm. And I'm in a mastermind with him and got to be very good friends with him. And he and I had these sidebar conversations, Joe, for the last year and a half. And that is, what in the world are people doing in multifamily? They kind of like have lost their minds.
Yeah.
And anyway, wrote this article. It came out in Bigger Pockets last week. And anyway, any special points you want to say about that, Joe?
The one thing I will say is we've got 3 reports in here that we will have, and this is one of those 3. The TREP report, the link to this, and we've got one other there, the CNN article that or video. We all have links to those. I just like what he said here. He said it was so crazy in the multifamily space. He said they were outbidding each other on the race to the bottom. I thought that was a good quote by him.
Yeah. By the way, just so y'all know this, Paul is involved in a fund that raises funds that invest in syndications.
Yes.
And they've done this in multifamily and they've done it in storage. And I believe they've raised about $300 million. Right. This is not an unsophisticated investor. He's a very sophisticated investor. And amongst sophisticated investors, we regard him as a very savvy guy, and he's a guy that I've listened to help get a direction about the market. So he writes some for Bigger Pockets and wrote an article, and he's sort of making fun of the newbie,
new rules, Eddie, new
rules, he calls them, kind of the new guys on the market, the slick guys that have done promotions. And, bottom line is the math doesn't work. Let me tell you something. Let me be clear about the multifamily market. Multifamily at the moment, the issue is not that it has dropped 25% in value and there's 20% that are in foreclosure. That is not the current state of the market.
Right. That's right.
The state of the market is we're right about, with multifamily, we're about where we were early in 2008. And that is, a lot of the troubled assets are in the incubation stage, and people are realizing they're in the incubation stage. That's kind of why the banks have cut off the money.
That's right.
Right. And this happened in 2008. People said, well, Eddie, the market hasn't dropped that much yet. And I said, yeah, they're all cooking in the oven. The problems are cooking in the oven. By 2009, then they started believing me.
Saturation, Eddie.
Yeah. So we had this chart before. I just wanted to show you this again. We'll make this PowerPoint available to you, but this shows you the different asset classes and sort of the trends that I believe where the market's going. This was on Market Watch. We won't overly beat this up. We have done this before. This is, so let me tell you guys a little bit about the TREP report. The TREP report is considered the gold standard for commercial real estate. Okay. So, if you were a banker, if you were anybody related to deeply doing any form of commercial real estate.
This is it.
Joe, this is Fannie Mae, and this is their loan production, since 2012. And you saw it really shoot up. So things got really good. And then bam, that was really good.
Yep.
Joe, this is their loan production this year.
That's a vertical line, isn't it?
And this is Freddie Mac.
Same
and
situation.
Joe, it seems like we've got somewhat of the same pattern here.
Yep.
So let me just tell you guys something. You got to know something's wrong, right? One thing that I can tell you is the amount of deals that are closing right now are drastically less than before. Joe, that might be a really good thing if you're looking at being able to buy notes and deal with people with some passive money to fund your business. Like, they might be looking for an alternative.
Yes.
Isn't that what we said in the opening?
A lot of money looking for a good, safe investment, and notes are it, right?
Well, and now the inventories drastically. When banks are in trouble, they're selling notes, or their clients are selling notes, and that's the pattern. Drastic increase. Joe, I thought this was interesting. Talk a little bit about this.
Well, yeah. So the Howard Hughes Corporation, everybody remembers Howard Hughes, right? But so the chair, Bill Ackman is on the board. He runs a big, multi-billion-dollar hedge fund, and he's on the board of this Howard Hughes Corporation. But David O'Reilly, he says, we were looking to build a new project in Houston, and so they threw it out there. And he says, Mr. O'Reilly says, zero showed up and gave me a bid. He said, I talked to 48 different lenders. Now, we're talking about a multi-billion-dollar company.
This is pretty much the flavor of the day.
Yeah.
And what we're trying to do is to point you guys, we get the opportunity to talk to some very seasoned, savvy guys that really have their pulse on the market, like right there at it. And so this is what the issue is at the moment, in which we keep saying this. We talked about last month, a monthly update. We talked about how much underwriting has changed in a year.
Yes.
Pretty drastically. Call it double the down payment. Call it triple the net income they require that a property owner keep after the lender gets paid. What's called the debt service coverage ratio. So
half the LTV, half the loan to value.
Yeah. Here's the deal. When you do these multifamily projects, it's kind of like a wave in the ocean. You can't just cut it off.
No.
And these projects that are in motion and already being built, they're having real struggles because they were on the boards 2 years ago, Joe. They were on the boards 18 months ago.
That's right.
And so the financial modeling that worked 2 years ago is not the financial modeling that works today. Why? Well, first of all,
18 months ago, the lenders were chasing the developers. Now that's the opposite, right? Yeah.
So vacancy is going up. Here's suburban and here's urban. So vacancy is going up. Number one, Joe. And here is the elephant in the middle of the room. These are we call them rate resets. But what it means is a loan is maturing and it has to be refinanced. There's a balloon due. Yeah. And Joe, we said that there's $1.5 trillion that are due. Remember that stat we had last week?
That's it.
Well, that number, I kind of drew up the top.
And there's your 500 billion there. It's a third of that.
And understand, and we had these stats last week, and understand, we're like, Joe and I are saying, guys, here's the problem. And by the way, guess who is purple? Yeah. The biggest guy of them all. Guess who that is?
The one with the most exposure is the banks.
Right there. This number represents the banks and the rates that are reset. And these loans are refinancing when their initial rate was probably half of what the rate is today.
And a lot of those are the regionals that are already struggling, Eddie.
Yeah, they say it's the banks that you have the 25 biggest banks, and it's the banks below them that did 70% of commercial real estate lending. So this starts explaining to you that while the Silicon Valley Bank was a big story about them buying long-term bonds that were low rates, and now market value of the bonds was, at a discount, and that changed the value in the books. The bigger story with a lot of these banks is these commercial loans. That's the elephant in the middle of the room. Joe, the one thing I can tell you from when I started in this industry in 1980, the one thing that I can tell you with confidence is that when banks are in trouble, the discount note business gets really good. It has happened every single time. Some things aren't the same every time.
Right.
That is a common thread. I won't take credit for this, but I have a really good friend, and we were talking about some mutual friends of ours that were still sort of, let's just say, completely enamored with the multifamily and weren't really buying into the fact that there was nothing going on. Like they couldn't, I'm not sure I would hire those guys for the risk management team. Okay. I love them, but I might not hire them for the risk management team. And my friend made a statement, and I said, I'm going to steal that. I want you to know. He said, I think a lot of people bet on the jockeys when you might find out it's better to bet on the horse.
Yeah.
So maybe if multifamily isn't your cat's meow right now, then maybe it's turned into a little more of a donkey. That's fine. No, just switch asset classes. Because if somebody's been in multifamily and raising money, then just raise money for a different asset class. And Joe, I'm speaking at some multifamily events.
Yes, you are.
You know why? I'm not trying to go clobber them. The market's doing it. I don't need to beat them up. I'm just saying there's an alternative. Notes have become the alternative when the more traditional alternative investments like multifamily aren't doing as good.
That's right.
Right? I'm trying to stay out of political trouble.
Let's
multifamily space. Listen, I've been doing this for 43 years. I will tell you something. Timing is way more important than doing things perfect.
That's it.
Timing of what you're doing and when you're doing it is more important than doing everything perfect. You can do everything perfect in the wrong market and still lose.
That's it.
All right, Joe, the rental market, it is declining.
Yes, it is. Yeah. Negative for the first time in 3 years, right?
Yeah. So once again, there are micro markets. So, Joe, we got to be careful that we don't say everything is bad. Every market is bad, but we are What we reached, Joe, I think, is this. The multifamily deals are struggling because they're struggling with how long it's taken to rent them up and
Right.
what they're able to rent them up for.
Exactly.
Right. If you're asking what's wrong with these new multifamily deals, they're worse than they were because they were projecting all these things that were going to happen. And now the real market is worse than they were projecting.
That's right.
Right. And then obviously the BRRRR market, right? The buy, rehab, rent, refi. That math is gotten to where it's not working. And of course, that's why we say seller financing is a real thing.
That's it.
Let's talk about this, Joe.
So the monthly new lease percentage change from a year. Look at the dollars there, Eddie. And that's just we're talking about a year here, right? From 18% down to, well, the highest one, which is Zillow, is predicting about 5%. And then the lowest there is a negative trend, and that's what we're seeing in the previous slide. Yeah. And that includes single-family homes as well, if you'll notice in the notes there.
Yeah, I had the co-star guys in my office, as you know, last week, Joe.
Yeah, we had a conversation,
and we were looking at data from those guys, and I think they actually own this entity too.
I think so. Yeah.
But anyway. Yeah, the market is, look, everybody right now is trying to figure out where the hockey puck is going. Joe, one of the things I want to talk about is, in fact, I try to never do this, but I want to go back a little bit because I want to talk about this TREP report. We are including this TREP report in this month's monthly update.
Yes.
By the way, guys, this is like a 60-page document. Yeah. Around page 22 and 23 of this report is where they talk about multifamily, right? Yeah. But they're talking about office and they're talking about
industrial and hotel and retail. Yeah.
It's a lot to read, but I want you guys, those of you that like to nerd up a little bit and read all this stuff, this is the gold standard report.
Yeah, for sure.
Right. So I just want to tell you guys that we're not just saying this. We're just giving you a book report on what we've reviewed. Right. This isn't just our data. We're gathering data from the most reliable sources, and we're trying to give you a quick book report.
Yes.
But I want to give you the ability to do your own research if that's what you want to do. Last but not least, Joe.
We've been talking about this a while, and now it's trickling in, right?
Well, the foreclosure rates are clearly increasing, and Joe, here's what I believe is going to be a trend right now. In our company, we're buying more pay-in notes that did have trouble. Right. They were in trouble and they were in default, but now they're paying again. Those are called re-performing loans. That is the biggest asset class we're buying at the moment. The second biggest asset class that we're buying is defaulted loans. And so here is the number. This is the Black Knight report that we allude to. And once again, it's considered the gold standard in this. So cumulatively, Joe, just to give a bottom line to things, right now, there's just under 2 million mortgages that are at least 30 days delinquent.
Yep.
Now, here's the most important part, Joe, and that is that the banks are not taking these assets to foreclosure. The typical deal that we're seeing over and over and over is they initiate a foreclosure and then they're liquidating and selling them as delinquent notes instead of taking them all the way to foreclosure. That is the pattern. So we're saying this isn't the inventory of notes of 2008 or 2010. Mm-hmm. Not suggesting that at all. But we're saying to you the amount of notes that are falling into our world is the most that we've seen since the early 2010s.
Right.
By far.
And, Eddie, there was a lot more then, but they were delinquent taxes and zombie and delinquent, no insurance and all of that. And it's not that way. Owed more than they were worth.
We're buying delinquent notes in a pretty stable residential market.
We are.
Right? I have never actually done that in my entire career in the past.
Counterintuitive.
Every time I've ever bought delinquent notes, the market was it was a falling knife residential market.
Right.
And we're going to have a falling knife market in commercial.
Yeah.
And we're going to be buying notes on commercial assets.
Yes.
So that's a different horse, and there'll be a different adjustment. This is just residential loans. This is not commercial.
Mm-hmm.
Right? So at the moment, this is what we're seeing. Honestly, guys, at the moment, we're keeping our powder dry. We're not buying delinquent commercial yet.
Yes.
We just don't. It's too early in the game to read how to price it.
Mm-hmm.
Now we're watching it and we're studying it, and I'm telling you that we're seeing portfolios. I know that we had one come in this week for $75 million,
mm-hmm.
but we're kind of tapping the brakes on doing it yet.
We're letting them we're letting them season just a little bit, Eddie.
Yeah, they're kind of like buying avocados.
That's right. Right. Yeah. Well, and I love the way that the industry is called. They're going to let them be a little more air quotes vintage before, right?
Exactly. Guys, we Joe and I did a lot of work. We had a lot of team members that helped us with this. This is a lot of information together. We know it's a story, and we're trying to kind of paint it together. And we're trying to paint it together of if there's something bad in the market, we're looking for the opportunity in it, right? We're not just trying to be the news guys say, oh God, those guys over there, they're dying and blah, blah. Well, okay, what does that mean? And how can that be profitable for us? The one thing that the multifamily story to us means we're going to buy distressed multifamily assets. We're going to buy distressed commercial real estate assets. Right. I'm not questioning that we're going to do it. In every other cycle in the past, I've been involved in wherever there was a distress, we made opportunity. But at the moment, what's really kind of happened to us is the banks are turning loose of assets, or their clients are turning loose of assets being notes
mm-hmm.
in a rate that hasn't happened in a really long time. That's caused by the pain they're feeling. And the other thing is where people can raise money to do the business. And right now, multifamily is thin. Oh, I know there's people out there that their only information they're getting it is from the promoter.
Mm-hmm.
And I can kind of guess the promoter's not exactly showing the same slides we are.
No.
Right.
Eddie, we termed a phrase or coined a phrase back in 2020 when the whole thing started. It was called looking for creases in the market. You remember that? Back in 2020?
Yeah.
Here's the crease in the market. Yeah. And guys, we're going to make available the TREP report, the CNBC with Andy there video. That's about 4 minutes long. And Paul Moore's story in Bigger Pockets. We're going to share those with you. So grab those as well.
Hopefully this is something that you guys can really share with your friends.
Please do.
We're just wanting the truth to be in the market. We're seasoned guys. We can find the opportunity in any market. Mm-hmm. I would say one thing, Joe, I'm going to say this in closing. I said this to some really mega seasoned friends here in the last week. I said, there are some times in the market in the past that I've not had fresh horses. Right. I was too invested in some of the things that weren't going good. Correct. I can tell you that, Joe, maybe a little age, maybe a little dealing, maybe a little bit too much, me having some issues in the past that I wish I didn't have. Right. I feel like we got fresh horses in the barn. Yes. We are ready for this opportunity, and my team is as busy as I think we've ever been around here. Our flow of notes coming in and opportunities coming in is really good. And I'm grateful for it. And I would say that I hope we're drawing a picture to you. Yes, we're identifying some pain, but with pain always comes opportunity.
It does. Absolutely.
Joe, I'm going to let you close us out, buddy.
Yes, sir. Guys, thanks so much for being with us today. And as Eddie said, please share this with your friends. the more information we have, the better the investors that we are. So share it with your friends as what's going on there. Yeah, just send it out there. Hey, share your feelings, share your comments with us, right? Please do that as well. Like the episode, and would love to see you guys in a master class. Eddie and our Chief Market Officer Matt Keller does a great 2-hour master class. Hey, and guys, we're going to let you come in. We're not going to charge you to come into our master class, guys, and it is we'll dig a little deeper into what we do at Note School and why you want to be on board as we move forward. So, guys, thanks so much for being with us this week. And again, remember to share, right? And we will see you same time, same place next week, 11:05 Central Time. Thanks.